I'm wondering what the read-through is for something like tech, because the day-to-day trading feels very much also related to big tech and growth, right? Like if you're going to see a hot jobs market, Fed's going to have to go more, you're going to sell growth, you're going to sell tech. And I'm wondering if we're seeing it that cleanly in the options market.
Yeah, I think that's a great question. And I think the thing to remember about tech is, especially when we talk about mega cap tech and, frankly, how crappy the earnings were a few weeks ago, it really goes back to Alex about how the meat is made, right? Because we have all these weights that were huge weights that are becoming less and less weighty. Facebook is probably the biggest example of that. I think it went down, 10 full percentage points in the XLC in terms of weight. But overall, FANGMAN names are coming less and less. And so what does that mean? It actually means you're going to get a less correlated index as other kind of industrials, financials, large cap pharma take their places as heavyweights. And overall, what does that mean for volatility into year end? I actually think it starts to dampen it because that correlation component is starting to decline.
So what do you like into year end then, Amy?
So, look, to keep it really simple into year end, one of the core themes in derivatives markets has been that equity skew has underperformed. So, meaning that out of the money downside option has been relatively inexpensive, not only in the US, guys, but also in Europe. And there's been a lot of reasons, a lot of narratives why that's true. A lot of it is related to positioning and how heavily people were in cash and already pre-monetized. But it doesn't take away from the fact that that tail was ultimately quite inexpensive as you head into year end. And, again, as I mentioned with the tenors, as we get to kind of play longer tenors rather than shorter tenors, I think you're actually okay owning an option that's a couple months long versus one that's only 1 day long.
When you see that in the equity volatility, do you see something similar than in FX and bond vol?
Yeah, so Alex, one thing that has happened, and we've talked to clients about this a lot, is when you look to FX vol and bond vol, they're just miles ahead of where equity volatility is. And so obviously that begs the question, is equity volatility going to rise up and catch up? But the thing that I think is important to remember and people have forgotten is that we had 10 years of rate suppression where there was kind of this artificial level of ceiling on rates volatility. So I'm actually in the opposite camp where I don't know that equity volatility necessarily needs to catch up. It's more a function of we don't actually know at the correct premium rates volatility should be because we just simply haven't been in this kind of rate cycle for such a long time that people, even if they're using 10 years of data, may not get an accurate ratio of where rates fall is relative to equity volatility.